Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com, and that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address. Disclaimer time. This is where I tell everyone to lighten up. It's just a podcast. Trading is like that roller coaster at the amusement park. Thrilling, unpredictable, and potentially stomach-churning. What works for one person might leave another clutching their hat in the wind. Our hosts and guests, they're awesome, knowledgeable, full of insights, but we're not financial advisors. So don't rush to make any investment decisions based solely on our banter. Always consult with a professional or do your own research. Plus, let's face it, we like to have fun, laugh, enjoy the trading ride together. It's all in the name of good podcasting fun. So remember, take it easy, don't bet the farm, and keep your seatbelts on at all times. Thank you for listening. Hello, everybody, and welcome back to the China Shop, home of the Band of Traders. I'm your host, Kyle, and joining me today is Chris Dover from PollinateTrading.com. Chris comes recommended to us by our friend and frequent contributor, Purdue, who unfortunately cannot join us tonight because he is out in Kansas City chasing that white dragon. But he did manage to send me a big list of questions for Chris tonight. Before we get to those, though, please feel free to reach out with any suggestions, corrections, or questions for future guests. Do that via email at bandoftraderspodcast@gmail.com, or you can join our free Discord server where a bunch of amazing people gather to share our struggles and lessons learned with other like-minded market aficionados. All those links will be in the episode description, so you can explore them after we get to know Chris. But speaking of which, Chris, thanks for coming on, man.
My pleasure. It's great to meet you.
How's your New Year treating you?
New Year was amazing. Started out with a trip to Mexico City for the holiday there. And with a bunch of friends and no kids, and it was a treat. So far, so good.
Seems like a lot of traders go to Mexico City. Is there a particular reason for that? Just because it's warm?
It's not that warm.
No, really.
Well, compared to what Purdue's dealing with, I suppose.
It's 9 here.
Yeah. Okay. I'm in Scottsdale, so we're back up into the 70s this week. So it's
Arizona.
Been tough. Yeah, it was a tough 2 weeks where we dropped down into the 50s there.
I grew up in Tucson, and before we moved to Illinois, I actually lived in Casa Grande for about 9 years.
Yeah, fairly close, isn't it?
Yeah. So tell me a little bit about yourself then. How'd you get into trading?
Let's see. I joined the Marine Corps prior to the global war on terror, and exited just shy of the beginning of that. And so it would have been 1999. Marine Corps, 2 big bases. One of those is Southern California. So yep. I was raised in Utah, and my first winter in Southern California really, was obvious that I wasn't going to go back to that weather. So I stayed. I stayed there, and I guess I always knew or wanted to. I don't know if that's right. I always wanted to be in the market. I always wanted to be a trader. I didn't actually understand what a trader was, but I knew that making decisions about buying and selling things, yelling into a phone from the golf course or something like that was probably the thing that I was going to do as an adult. That was my plan.
That's not usually something a kid thinks about, though. Did you see a movie, or did your dad do something
Caddyshack,
similar,
right? That wasn't that,
okay.
Buy, sell, whatever. Actually, no, honestly, it was a weird thing that, like Alex P. Keaton from Family Ties, a way old movie or TV show, but he was this teenage business nerd. It was like things like that always really got me excited. The movie Wall Street, things like that were always very, very exciting to me for some reason. sports and all that other stuff too, of course. But that I just knew that that's where I wanted to go in life, and or at least that's where I thought I wanted to go in life, I suppose. So I got out of the Marine Corps, stayed in California, and I spent a handful of months interviewing at a bunch of brokerage firms. And I didn't understand what being a broker was. I thought that's the job I was actually looking for, but turns out being a broker is like getting on the phone and calling 200 people a day saying, hey, buy this stock that we believe you should be in. And
it's a lot more customer service than the guy on the floor, yelling and waving.
Exactly. And I didn't really know how to do any of that stuff. I just knew that it was like, well, that's the market. So I did all these interviews, and if for some reason nobody wanted to hire the guy who said, no, I'm not super into the idea of calling a bunch of people all day. I just want to make trading decisions. That's what I wanted. So that was a hard few months of just not reading the room, I guess.
Did you have any schooling or education to pursue this too? Or are you just going into interviews thinking, I got this?
Yeah, just that.
I love that. Love that confidence.
Yeah. I'm a community college dropout, so multiple attempts.
I went Navy because I couldn't do college. That's why. So
yeah. Whatever. I certainly wasn't qualified to. If having a bachelor degree was a qualification, I didn't have that. But so I was kind of like going around to all the networking events at the time, and I was, tricked to talk to these girls at a booth like they do. And it turned out it was a prop trading firm. And, two guys come walking around from behind the booth. Oh, hey, how you doing?
Right.
And turns out one of the guys was a former Marine himself. And he was the CEO of the firm. And, we started talking about it, and, we were like, oh, it's exciting. I could totally get into this. And, we were going back and forth really, really well. And he's like, so, we just got to make sure you got your degree. We got to make sure, I was well, that's the problem.
Right.
I said, I was a Marine. I just did the Marine thing. And I've been out. He's like, oh, you didn't go to school or anything like that? I was like, well, I applied. They didn't want me.
Right.
And he's like, well, actually, you're uniquely qualified to work with me specifically on this project I have. I was like, uniquely qualified. I was an infantry Marine, need some doors kicked in and that. Right. He's like, I just need somebody who, when I tell them to do something really freaking dumb that they don't know that's right or wrong, that they'll just do it. I was like, your guy
sounds
right here. Yeah, this guy, that's me. I'll complain probably, but I'll do it for sure. And he's like, that's it. That's just what I need. I got a bunch of, people here who are well overqualified in their mind for doing any of the work that actually needs to get done, but they'll write, 200 page documents about all the work that needs to get done. All these other things need to get done. But when it comes to like pulling cables and, plugging in servers and coding up software and building trading algorithms and all this other stuff, they're kind of like, either they don't know how to do it or they're too cool to do it.
Yeah.
And I need to start just getting people to do what needs to be done, as opposed to tell me how important they are the whole time. I was like, yes, let's go.
Right.
And that was my intro into it. So he basically said, look, I'll teach you how to trade discretionarily, well, systematic really, but I'll teach you how to trade, to day trade. And this was the height of the .com bubble. So it was really kicking off everywhere. He said, I'll teach you to trade for the first couple hours of the day. And then after the open is done, you'll be doing nerd shit. I was like, yeah, let's go. And so, this is Southern California. So, market starts 6:30. By 8:30, 9 a.m., I'm working a regular job, basically learning all the stuff that really was just the cutting edge at that point in time. Nobody was really doing software at that time. Nobody was, it was just new.
So was this before 2001? You said?
Yeah, it was in 99.
So how did the trading actually work then? Because were you having to call an actual person to like place your trades, or did you have a terminal?
We had trading software, and it was called direct access trading, and you would just what you do now, but like a level 2. We had level 2s, and
Okay.
it was kind of honestly, it's not too much different than today for a lot of trading.
Just
Honestly,
probably slower.
A lot slower.
Yeah.
And one thing that we were doing at that firm was writing software to be able to really just not need to actually be remote to provide. So at the time, you were either calling in orders or you were professional and you worked at a prop firm or something like that. So it was a prop firm, and we had a trading floor, and which was a blast. Probably the last opportunity for a trading floor. It was just a bunch of terminals everywhere, computers everywhere. There was one dedicated broker to the floor, and he had access to some of these. They're called ECNs, electronic communication network, or something like that.
Okay.
Where
Yeah.
you would find arbitrage. You could stare at the level 2. You would see Microsoft was trading at, I don't know, 33 and a quarter. We were in fractions at the time. And he saw somebody buying at, let's say, 33 and a half. So he would just mash the 33 and a quarter. And as he was doing it, with as much as he could, 5,000, 10,000, 20,000 shares, and he would just yell out, offer 10,000 softy at 33 and a half, or 33 and whatever, to take that little itty bitty spread, and the other broker there running that other network would hit it. And so there was a lot of that. Like,
it's almost like some arbitrage then.
It was definitely arbitrage, and it was not it wasn't code. It was just dudes hitting buttons. And it was pretty cool. But yeah, we do 200-300 trades within an hour or two of the trading day. And then, we were done. And from there, I learned how to build software and learn networking and just all that sort of stuff, really.
That's kind of almost the best case scenario then. You want to get into the field. Not only do you get a job like in the field, but you have the guy who's teaching you how to trade, and you're learning how to do all of this stuff to build a company because nobody else wants to do it. I'd sign me up. I got
Well, and I mean, we built so that company, that prop firm, and the software got acquired, and by our clearing firm. And the same way that got me hired was the reason that got me laid off. It's like, oh, where's your degree?
Right.
Out the door.
But hopefully by that point you'd already learned.
Well, yeah, but him and I developed a really good relationship, and he him and I went and started another software company, and I left it after about 3 years, 3 or 4 years. And he continues to run it, and well over $1 billion valuation. So it was a great opportunity working with him, and still a great guy.
That's freaking awesome, and that's a hell of a story too. You kind of mentioned a little bit there. You mentioned discretionary trading, and then you said systematic there, and that's actually one of the questions Purdue had on here, was to kind of talk a little bit about the differences between the two.
Absolutely, I think there's a journey that, and it's a experienced and learned evolution, I guess is the way to say it, rather than just kind of, in essence, a lot of people like to start on third base or on the 25th mile of a marathon,
right?
And say they ran the marathon, or whatever it was. But the reality is they haven't accumulated the experience and the knowledge to, sure, you can say you finished a marathon if you started at 25.2 and ended at 26.2 miles. You can say you finished a marathon, but you didn't actually run a marathon.
Right.
I don't know if it's the best analogy, but that's what I see so many traders doing, is they want to fast forward to the final chapter. They want to fast forward to the very end and go straight into the hardest part of the job, where you don't sell books, and you don't, like, people are not interested in hearing about really boring, non-exciting, non-eventful. So what are we, 24, 25 years I've been trading, and the things that people ask or talk the most about are like 9/11 or .com 9/11, global financial crisis, whatever, Asian debt, European, Arab Spring, commodity, 2018 COVID, like those single events that were just like, yeah, global financial crisis was about 2 years, but it was like a period that it was just really insane and wild.
Right.
9/11 was, a day and about 2 weeks of trading, week and a half trading or something like that was shut down. And then another couple of days, and, COVID was a month. And, people are really focused on those events, and they just like, oh, I just got to be that guy who's ready to go on, when
everybody wants to be Michael Burry.
Exactly right. Everybody wants to be Michael Burry. They want to be the one who steps in at the absolute bottom, buys it, and makes their career. The thing is that there's, we're looking at 25 years, so 10,000 trading days that happened within that period of time, that if you don't manage those days, you can't even show up for the one opportunity that is there.
Yeah, no kidding.
Because it's a boring, trading is very boring for 99% of the time. Really, really boring. And where people really get in the most amount of trouble is when they're bored, or
yes, I've noticed that.
Yeah, trying to force a major market top.
I've been sitting here for an hour, like, oh, I need to do something. Okay, this looks good enough. No, that's not good enough.
I'm gonna take a flyer on this, take a flyer on that, or whatever. Now, I'm not to say that you can't do those sort of things, but I guess really what I'm getting at is, until you can get to the point of really being successful, a Michael Burry scenario, is you have to accumulate a lot of experience to realize that you're going to have to, you need to, it's almost luck. No offense to Mr. Burry or anybody else who's done amazing things in that sense.
If you caught a top, then yeah, that's pretty much luck.
Well,
they're going to happen
maybe
eventually, but I mean, I think it's an element of luck too.
I think so. What it really is just staying in the game long enough for luck to happen.
Yeah.
And, and not put luck as your teammate on the field.
Yeah. Like, okay. So for an example here, like the story you just told about meeting the people that kind of put you on your career, that sounds lucky to some people. Some people call you lucky for that, but you put yourself in the scenario to get lucky. And there's a difference, I think, between the two.
I was not born special to have the fact that to know to like go to this one networking event, and that it would turn like accept a no salary job for whatever it was to put myself into it.
No, you went to many of them over the course of multiple months, and then managed to hit on one of them. That's not luck. Yeah. That's just odds. The odds are in your favor if you stack enough of them like that.
And that's what systematic trading is about, is to find a small edge and just play it out. So really what I was getting at in that whole soliloquy was that a lot of people want to go straight into that big macho, I'm buying the dip, I'm selling I'm selling the top, this thing's going at whatever. And the systematic side is the thing that you will get to the point to be able to recognize that this is legitimately a place where you could consider things are too expensive, too cheap. Conditions are wild, because you actually have statistical data. You've got a lot of analyzed data to understand where anomalies are and where they're not. And usually what you find in the systematic work is you start finding these, we 6.5 hours of live trading in equity markets on a Monday through Friday or so. In a systematic trading environment, let's say you're day trading, you may find yourself 3 trades a day in that environment. You may find yourself 3 trades a week in that environment, or a month or something. But the point is that when when those conditions line up, you're there to take advantage of them. And then, okay, so you're in the right spot for the good conditions, but it's not so much just that. It's also what size is your position? How much risk are you putting on? How many times does this happen over the course of a week, month, year, of a lifetime? And if there's enough of it that you can do things, for example, I got into card counting in blackjack because just very simple that if you can do like arithmetic fast, which is just practicing, it's nothing special about it. Rain Man notwithstanding, Dustin Hoffman or whatever, like there are special folks I'm sure out there, but I did just fine not being super gifted with it, just saying, okay, I just need to learn how to count how many, how many of these types of cards are in the deck and how many have already been put out there, what every other card on the table is doing, and how I bet, most importantly. And systematic trading is really about that. It's just knowing what game you're playing, and then knowing where the places are to put risk on, and where you have no opportunity to put risk on. So there's really no point in that.
Because you use the marathon analogy, like everybody wants to start running at the end just to say that they finished, or they want to get to the finish sooner. But like, where's the actual proper place to start then if you really want to learn how to trade and do it right?
Yeah, so that's where you get into systematic. I think that you should not get into discretionary trading until you have predictable, repeatable returns. And with discretionary trading, usually what happens is you start out in a discretionary place and you suck. And then you're just like, oh, I'm just going to follow these simple rules as long as I stick with these rules. And then you discover that, the rules change, and then it gets into market regimes, gets into different environments, doesn't work all the time. So when you get into that systematic side, then you actually have a lot of different routes that you can go. And then you take that perspective and look at what you were doing as a discretionary trader. You're like, oh, awesome. I was short selling every rip in a early bull market, which is, one of the most violent short squeezing environment out there.
Guilty. You've done that before?
Yeah, we all have. I mean, we all start that way. We all start that way for sure. And so you just understand that, okay, you could start even if you were just going to go systematic, if you just started and said, let me figure out, so that the evolution goes from discretionary to a systematic, and systematic is just purely rules based. And then the evolution from just rules based is you start to understand, oh, so there's rules for this, there's rules for that, there's different regimes, different market types that you can do certain things, and there's different types where it doesn't. A big, a long, slow, boring bear market like we had from 21 to 23 so far. The things that you were doing in 2020 and 2021 didn't work.
Right.
Or they worked in like certain small windows. And so that's the next step in the systematic side, where you get into understanding, now you have systematic tools, applying the right systematic tools to the right market environments, the right market regime. So a sideways, boring, slow market, you want a mean reversion type strategy. So you're not doing breakout momentum systems in a neutral sideways market, and you're not doing you're not shorting rips and buying dips in a high a high long only or short only momentum environment, and vice versa.
Right. Rich Friesen talked to us a lot about market moods. I think he was the first person who kind of came across it. He calls them market moods, you call them market regimes, but it's the same concept. Like, you have certain strategies that perform better in different environments, and you have to start figuring out how to categorize those different environments, so that way you can start tracking your strategies to them. Something that's a lot easier said than done, though. I've spent quite a bit of time trying to figure out how to define the different market environments, like the way that I see them.
Yeah.
And they're constantly changing. Like, I'm constantly tweaking. I feel like I still haven't found like the right answer for me. Like, how do you define them? Like, what's your systematic approach towards that?
So the more experience I have, the easier it is for me to identify it just on price action.
Mm-hmm.
And maybe taking the temperature. Like I could look at a handful of things and understand what type of environment we're in and what sort of trades would be that I would start pursuing.
Mm-hmm.
But that's because that's at the other end of the systematic. You go through that period.
Yeah.
But the thing that really did it for me was a tool called the SQN, System Quality Number, which was originally created by Dr. Van Tharp and his crew, all his folks.
And that SQN indicator, that's free on TradingView too, isn't it?
Yeah, it's I have it. I created it in
okay.
TradingView, and so if anybody wants it, just go to TradingView, type in SQN, and you'll see Christie Macro, and it's the one that there's a couple of them in there, so just do the one that has the most followers. It might be.
I'll link it in the episode description. I'll find it.
Yeah,
it's
free.
I want to check it out.
Yeah, it's free. Use it. You should be able to see the code if you want to tinker with it. It's nothing too fancy.
Mm-hmm.
And it actually came from a statistical tool to grade your trading systems. So we use a lot of metrics in trading of the quality of your trading and how good you're doing. A lot of people fall victim to the idea of win rate as a good tool,
mm-hmm.
or high win rate or low win rate as a good tool, and it's irrelevant.
Yeah, depends on your
risk reward.
Right? Profit factor is probably a little better.
If it keeps you in the game because you have a high win rate to get you to the next point, so you can move up the chain, up the ladder of success, then it's not bad at all. I know a lot of people that need a high win rate
mm-hmm.
to maintain that work. But of course, you're not going to get a high return and high win rate over time. It may happen, for a week or two,
mm-hmm.
but you do it for a couple months or hundreds of trades, and it just, it's gonna drop. So sometimes you'll have a guy like Paul Tudor Jones, who's really known for 25 to 30, 40% win rate, but he's got more money than all of us combined.
If you hit 10x on the ones that win, you're risking 2 on the ones that lose.
That's exactly right.
The math works out.
Or you have a high win rate, and so you're risking 2 to make 1 or something like that. So that tool measured our systems. So it didn't matter if we had high win rate, low win rate, high volatility of our system or low volatility of the system. That SQN tool was a statistical way to put a number on your trading system and say, this is a good system. Doesn't mean, look, if I'm early on-ish in my career and I need mentally to have a high win rate because, I can't handle multiple losses or something like that, then even though the system quality number of the SQN of my system is great, I'm not going to be able to trade it. So, but it's the first step in saying, this is a good system. The next step is, let's go see if you could actually trade this system right now. In the future,
right?
You could.
Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com, and that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address.
So then we started applying that to the markets, the underlying markets, and I break it down into a number of. First of all, we have to understand the underlying incentive of the market that we're trading. So, for example, currency, and I'm talking on like daily, weekly timeframes, like bigger picture. Currencies, for example, are not the major currencies are not really designed to trend. Like you would, going long the dollar Dixie at like 93 and holding on to that till it gets to 15,000, the world is over.
Yeah. Okay.
In Argentina and Venezuela and
Right.
Turkey, like it's different because those aren't reserve currencies and, whatever other things there. But generally speaking, the G7 currencies are not built to trend and do a whole lot. So you have to understand, okay, if I'm analyzing a currency, I need to understand that this is more of a mean reverting type environment. Yeah, we could have months and, years or weeks or whatever that it could trend, but it's definitely not going to be a direct line. You drop it down to a 15-minute, yeah, you could get good rips. So that's one thing.
Right.
When we look at equity indices, for example, the big cap ones especially, they are already optimized systems to go higher. If the economy is generally improving,
Mm-hmm.
and it doesn't even have to improve the way these algorithms are built, if companies are increasing earnings, well, if they're better than another company, it's going to be in the index. So the S&P 500 is a 500 top companies.
Yeah.
If the 499th or 500th top company is underperforming the 501st and 502nd, they're out. And so you're optimizing for the best.
Yep.
Just, like a roster on your sports team. You're just like, okay, this running back is getting 10 yards. This running back's getting 100. That's my running back.
That's an excellent point. I remember talking to the indexes go up all the time, but the companies that make them up change all the time. There's companies within them that go bankrupt, but the S&P doesn't take a hit from that. It just replaces it with another one. That's something that I think kind of gets lost if you don't really
can. we have the same access to that market.
Yeah. That's a great point,
a lot of people get caught up in the headlines. They get caught up in the angry, cranky macro guy analysis that the world's going to end, and this
Michael Burry.
Yeah, there's 99% of the market is like that. It's like really huge population of people in the market don't think about those sort of things. To the point on Michael Burry, at least when he puts his bets on, he does use proper, I would say, position sizing.
Yeah.
So instead of shorting 2 billion, he shorted 2 billion notional. It was a trade he did earlier this year that people were all, he just bought a bunch of puts,
was annoying.
Or whatever
that was just
derivative it was. Yeah.
Yeah.
So I don't know anything about the guy. I just know that a lot of people will follow him and go in that direction, and I'll play them pretty easily.
Right.
They're useful. But yeah, so if you're looking at that at a product like that, then the underlying incentive is to go higher over time. So when I'm looking at my SQN environments, now I go back 150 years of data on the S&P 500, but about 100 years. And I can see, back to the 1920s, I can see that 80% of its time, it was in a bull market. It was in a bullish regime. Mm-hmm. So over 100 years of data, that single index, the S&P 500, has been in a bullish regime.
Wow.
So right away, I know, okay, I just need to, if I don't have a bullish regime system for that's already, like, they're already handing me a number go up type of product.
Right.
So if I'm not just like, okay, there's this raging river going that way, and I want to get to the, I want to take advantage of this river, jump in and go.
Yeah, right.
Don't jump in and start swimming against it. One of the other things about that is, so I have 3 directions in my regimes: bullish, bearish, neutral.
Okay.
And then there's high volatile and low volatile.
Hey,
so
that was the way I started with.
There you go.
Interesting.
And my measurements of volatility are just the percent change day over day, not VIX, not nothing. It's just that individual asset, whether it's Apple, whether it's gold, whether it's euro, Bitcoin, S&P, whatever it is. What is the change day over day? So today's change on S&P was negative 0.37%. Friday, I don't know, it was up, I think maybe. And then it averages the last 100 days.
Okay.
So in essence, what we're doing is just getting an average of the direction of the last 100 days and the average of how much it changed in a percentage change day over day.
Mm-hmm.
So you should very easily understand that you're rising. You should be able to look at that last 100. You don't even need it on a chart to see that it would be going up or going down. If you were to just go look at how many percent ups and percent downs kind of were in a spreadsheet column, you could pretty much understand the direction that is the river is flowing. And you already know that 80% of it is going to be going higher in the S&Ps or the major indices. So you probably don't even have to think too hard about which direction it's going to go. The other thing that you know, that the last thing that's really interesting about that is only it's about 1% of all trading days in over 100 years are extreme bearish days.
Wow.
So if we're looking at, let's call it 110 years of data,
1 day out of 100?
1% of that was an extreme market bottom.
And what's your definition of extreme? Is that just the percent change?
It'll be the accumulation of the previous 100 days direction. So think of like COVID bottom.
Oh, okay. So not any specific day. It's any stretch of periods that you're looking at. Gotcha.
So that's another thing you start understanding is like, okay, well, where do major market tops exist? In what environment do they exist? And if you know that, because so many people are always worried that if they come in and buy, if they've finally been convinced to buy after they've been super bearish forever, they're always worried. The reason they don't buy is because they're always worried that when they do finally buy, that's the top. And, it is usually for most people who are in the trading game, not, my father-in-law, not people like that who are just kind of like, man, bought Apple, man, that thing goes up.
It wasn't that long ago when I found myself thinking that like a short. Nope. Okay, fine. I'll go long. Nope. Now it rips. It dumps on me.
Yep.
Like, yeah, I've been through that cycle a few times.
You and everybody else in this game.
Yeah.
If you're still in this game, then you've done it, or you're going to do it.
Well, thank you. That's encouraging.
Well, it's that evolution, right? You start out with like, I know more than the market. These guys are idiots. I've experienced more life. I'm smarter. I'm everything that everybody else is. And then you realize like, well, that doesn't matter. Let me just get into statistical, systematic stuff and just kind of bang, bang, bang. And then after you get through that understanding of all the statistics and like where you can like play around a little bit more, once only 1% of all days over 100 something years, you have a major spike bottom. So the only time I need to be thinking about, I need to mortgage everything in my entire life to buy this thing is one of those one of those periods.
Right.
Or I don't, whatever, or I just put $100 on it and it's going to work out because it's going to be that major market bottom where I don't need to put a whole lot of risk at work and it's going to play out for a very long time. And so those are some things like that. Gold has a different sort of incentive scenario than like indices. Bitcoin has a very similar, if not way more incentive to go up.
Is that because of the scarcity?
That's right. Yeah.
Yep.
And the demand now. But the thing about it is because it's not controlled by institutions until last week. There wasn't.
We finally got the grayscale ETF finally went through.
11 Bitcoin spot ETFs went through last Thursday. I started trading.
Grayscale got one of them, right? I hope.
Yeah, Grayscale.
I think they were first on the. Yeah, if they didn't get one, I was going to be pissed.
Well, they. So just a side tangent. They sued the SEC and they won. Yeah, and they're the ones that created. Yeah, they're the ones that created. They caused this whole thing. And so it's to their credit, but they also were charging 2% management fee for that trust, and now ETFs are at like 10 bips.
Yeah.
And so everybody who was in Grayscale just sold instantly because, it was just crazy how much, 2% versus like 200 bips to 10 bips.
Hang on, I got to pull up that chart.
So yeah, Grayscale's kind of been in some. It's just been rolled over for a lot of it. A lot of people have just rolled over their crypto into other, like IBIT or ARC or any of those others. But like certain cryptos are, and crypto in general is amazing. It's actually far easier to trade crypto than it is other markets.
Why do you think that is? Well, less algorithms at play, or less people trading?
Well, there are definitely algorithms involved, but we're not talking the high frequency and the amount of capital that is involved. Such a large, the majority cohort is individual traders, and they're not super sophisticated, which is actually lovely. So you kind of try to apply Fibonacci or an RSI, MACD or something like that to the S&P. It's kind of hard. It's not the easiest game to play. You do that on, whatever coin, I don't know, come up with, any name, a crypto name, and Chainlink. There you go. Yeah. Pancake Swap, Sushi Coin, any of those, Arbitrum, Optimism, like there's thousands and thousands of them. But you'll see, okay, there was a big parabolic rip, boop, and then it comes back. Where does it come back to? Well, it rips through that 61.8 fib level, but that's the level it holds. So it's not going to be like precise. So you got to understand that anytime you play that game of precision, you're gonna get ran in whether you're trading sugar, cocoa, or crypto or S&P or whatever. But it stops right here at that fib level, goes up, comes back down for another retest, and then starts going in the bullish regime. When you have it in the proper regime, you can trade, you can understand, okay, it's not just the huddle mindset. You have to, what everybody's saying and doing isn't what you have to be doing if you're going to, your job is to make money in the markets. Your job is not to participate in yelling at the market for going up when you want it to go, when it should be going down for reasons, right? For all the 10,000 reasons that the Fed, this, that, the other, or whatever. But if it's not, then in essence, if the S&P is going up, that's what it should be doing. When it goes down, there's something that's kind of wrong.
Yes. So the idea then is basically that because there's more retail investors or more retail traders trading in the crypto space, then the things that retail traders tend to gravitate towards, like technical analysis, they tend to have a stronger efficacy because there's more people following it and respecting it. Is that kind of the idea then?
It's a self-fulfilling prophecy. That stuff is, generally speaking, self-fulfilling. It's just a really good way to get a visual representation of emotion. And not everybody is, believe it or not everybody is a diamond hand hodler in crypto. No. There are plenty, and they are big contingents, and they're loud, and they're annoying, and blah blah blah, and you love them, and they're great, and it's. But if you can just remove yourself from that and be a trader, then whether it's the euro, whether it's the 5-year, whether it's the boons, whether it's the yen, whether it's the SPOOs or Tesla or Nvidia or whatever it is, trade it. If that's your thing, then just trade it. You don't have to jump into the narrative or the the big stories to make money. And so much of in the bigger markets, it's small people LARPing as $1 billion fund managers. It's me and my $10,000 account is not the same as Warren Buffett. And so, when I'm sitting there talking about all these big things, sure, that 10,000, if you keep playing the Warren Buffett game until you're 100 years old, you probably are going to do pretty darn good. I don't disagree. But at the same time, if you're expecting 200, 300% returns and, you're showing up to work in a suit to manage your $10,000 account in your parents' basement, it's, just for the job you want. I got it. I'm in my parents' basement right now, by the way, so no shade.
I'm in my basement.
Yeah. I'm just kidding. I'm not in my parents' basement. But no shade on those folks. I'm closer to you than I am to Warren
Right.
Buffett or anybody else. So it's just, I'm trying to be a little bit more realistic about the idea that,
You don't need a massive account in order to make a good living, I think is kind of the idea, right? Manage your own risk and your own expectations.
My friend Darren Johns, he says this the best, Darjon25 on Twitter. You keep trying to play that game, or folks keep trying to play that game that Susquehanna or Jane Street or Citadel is playing, super complicated stochastic math, trying to come up with the perfect system so that you can make $17 at the end of the month. The reason that they're doing that is because they have to do it with billions and billions and billions of dollars, and a 17 basis point move to them is actually big money.
Right.
They're leaving just piles of $100 bills on the floor for you to go to pick up.
Right.
But you get caught up in the idea that I'm not going to do retail. I'm not going to do retail stuff. You're like, dude, retail is where the money is in this environment where you're playing. That's where the money is to be made. It's not, it doesn't have to be in this big, crazy stochastical math type world. You could just simply, I just told you 80% of the time it goes up.
I mean, that's another great point too, though, is like having a large account is almost a handicap. Like those big institutions can't trade the same way that you trade.
They can't.
Because I mean, I'm sure you'd love to be able to slap 1,000 contracts on, NQ or ES and do the same thing you're doing, but it's a lot harder to get your fills and get in and out and not be stuck holding a giant bag when something goes wrong.
That's right. You hit that 1,000 number, you better be trading ES, not NQ. Because even though it's a big contract, the NQ, it's not nearly as liquid. Or you have to get into 10-year or something.
Right.
But totally true. There's so much money left on the ground, just sitting there to be taken if you just understand how to do really good risk management and understand the incentives of that market, and just find that predictable, repeatable pattern, predictable that you can predict that you're about to have a trade. Repeatable, that the trade will repeat enough times over time, you can make money. The outcome is, you should know what your outcome is. 50% of the time is going to be a 2R winner. 50% of the time is going to be a 1R loser. Okay, cool. Great. Make money forever doing that. I'm on it.
Yeah. We're starting to get close to the end of our time here. So I want to make sure that we covered this topic before we run out of time here. But backtesting, I want to talk to you about, I want to hear about your process. Like what does it look like to take, like, say you start with an idea, like how do you turn that idea into something, or what process does it go through before it makes it onto your like playbook?
There's a lot of observation and notes.
Mm-hmm.
And I'm glad we're hitting this subject. I think this is probably the single best tool that a retail trader has at their disposal.
And there's a lot of our audience that wants to get better at it, myself included. So anybody who's been successful at it, we want to pick your brain.
Okay, first things first, you need a spreadsheet or a pad of paper and a chart. That's it. You don't need software. You don't need anything special. You just need to do it. And let's say you have an idea, and okay, so usually what I'll do is I'll just jot down my ideas over and over and over. Oh, I see this. Oh, I see this. Oh, I see that. Write it down. Eventually, I just get to a point where I'm like, okay, let me test this one single thing. So you usually have to narrow it down quite a bit from, okay, the open does this, that, like, okay, let me choose a specific time, one specific asset, and then one factor, one thing that I can do that there's no discretion in it. So, what is that? 2 bars up, 1 bar down, 3rd bar up maybe, or something, like really simple.
Right.
And then you go and collect blindly. The best way to do it, in my opinion, is you just go to a random date and bar, and that's like, you don't see anything from the next bar forward, and you apply your algorithm, for lack of a better term, your trade setup bar by bar. So you just right arrow the next bar. Is that the setup? Nope, not yet. Is that setup? No, not yet. Is that setup? Okay, it looks like it's starting to happen. That's predictability. Boom, boom, boom. Okay, there's the setup. Okay, so you go enter your entry, your stop, your profit target, the time of day, those sort of things, so that you can go back and do it again and again and again. And so that process can take, well, right now for me, I do that every day. I've been doing that every day for about 15 years now. I do about an hour a day, every day. That's the thing that pulled me out of inconsistency.
Yeah.
So that, by the way, that was 10 years into trading. I was taught that stuff in the beginning, and then I became Mr. Like, I know stuff. And then it took me time to get to the point of like, I don't know shit.
Don't get me started on that.
Yeah. So
I've had experts coming on here for 3 years telling me everything I need to do to be successful. And it's only like the last year that like some of those things are starting to click. Like, oh, that's why he said I need to spend time watching and not trading. Oh, that's why he said I need to do this. Or that's what he meant by this.
And the thing about this backtesting thing is so again, I have 25 years of trading experience under my belt. Let's say that's about 220 trading days a year that I've done, maybe 200. Mm-hmm. Let's call it 3 trades a day. So that's, let's go with 600, 1200. What was that? 15,000 trades, I think is the number that comes to. Somewhere around 15,000 trades that I theoretically have done over that 25-year period.
Yeah.
If you went and did an hour of practicing and accumulated, let's say 30 trades in that 1 hour of practicing, that's the equivalent of about 10 to 15 days of actual live trading experience that you accumulate in 1 hour doing a manual backtest. So your practice.
I love that reframe.
So and I ask this question a lot, and very few people actually get the answer. Purdue answered it correctly. Maybe because he hangs out with me, so he knew the answer already.
Smart guy.
Smart guy too. I asked the question, so I knew the answer. So I'm not saying,
Well, what's the question? I got to know now.
The question is, if Kobe Bryant was to become a day trader, what would his trading day look like? Knowing what you know about Kobe Bryant's training as one of the best, basketball NBA players in history, things we know about Kobe, a lot of people will say, oh, he's a gambler, or he, it's not what I'm talking about.
No, he's going to be practicing 90% of his time.
That's right. He is known for He was known for practicing 4 practice sessions per day, whereas the top competitor he ever went against was like, an hour or 2 in the gym and then an hour or 2 on the court. Right? He's doing 4 of those a day.
Yeah.
And he just started like running away from everybody else. And that's the exact same thing. You have that opportunity. Every trader who wants to get in this game has that opportunity to practice. And you want to get good. You spend an hour a day for a week, just your first hour. After you get that under your belt, you're going to be seeing the market completely different. You're not going to be, you're going to have a lot clearer picture of what you're doing, because first of all, you have no emotion. You're not like caught up in what's the next bar going to do? What's this? That? I have real money on the line. And what am I? You're not. You're just objectively looking at things, watching it go through, documenting it. And, a lot of people will say, well, man, that's not the same as real trading. And like, again, I was a Marine infantry, and that's like saying, well, shooting paper targets is not the same as actually getting shot at. So don't practice shooting. Yeah. Like, don't practice the stuff that you need to do. Like playing a football game is not the same as it is at the Super Bowl. So don't even practice, just play the game. Like, it's ridiculous. But so many people will say, oh, backtesting, paper trading, all that stuff is not the same. No kidding. It's not the same. But
people don't want to do it because it's not sexy. It's not fun.
It's not gambling.
Yeah.
How many times have you went and put, went to buy one contract of, let's say S&P, and you put in 11 on accident. You didn't realize you hit 1 twice.
Like, I haven't done that one yet, but I've done 6 instead of 1. That was enough to skip a beat. Yeah.
Or how many times have you put buy instead of sell, or market order or a stop order instead of a market order, or whatever? Like,
I do that when I'm backtesting all the time.
That's where you should be making your mistakes. It's exactly where you should be making your mistakes. So that when you get into game time, you're not making the mistakes that you can eliminate in practice. That chest pass Kobe would warm up with every day. Then the bounce pass. He would, dudes, MVP, rings, and he's practicing passes.
Still doing the basics.
And he's not going to pass, by the way. Like, he's not known for that. But he's the best at doing it. So that should tell you how, what he respects of you in your practice session, folks.
Yeah.
But
Maybe if
anyway,
they would have practiced as much as he did, he'd pass him the ball.
exactly. And the ones that
Yeah.
did probably received the ball. So, that's really my thing on back testing is all this stuff I'm talking about, 80% of those days, I just accumulated that data and it sits in a spreadsheet and I look at it and start slicing and dicing it. And then back testing, I'm getting a system figured out that I can predict when a trade's coming up, repeat the trade, and then understand what sort of risk management I need to use to turn that into a monthly or yearly returns or whatever it is that I'm after. And then I'm practicing it. So, by the way, go back if this sounds like it doesn't make sense, go back and retrade today. Just
Yeah.
go back to the open. There's your line on the chart, and you can't see anything past the open. You already know what happened, by the way. So you have a bias. So go now with that bias and trade today like you would have had you known that today was going to be a 37 basis point down day move on the S&P. And what would you have done differently? You knew that, we had a good run into the morning and then we had a Fed speaker come in and slam it down. And, you knew all this stuff was in there, but just like you would in practice, you know what the play is supposed to do. If, let's say your sport, football or whatever, you know what you're supposed to do at the play. You know where the best defensive player is on the field. You know how they react to these things because you play them every day in practice, but you still practice it. You know what the outcome's supposed to be. Your defense not surprised that you're going to run this play over and over because you're literally practicing that play. That's what backtesting is you're practicing it. And I'm going to go practice it in the worst conditions and the best conditions, just so I'm so good at it. And then I have thousands if I went and did an hour a day of back testing. So today it's about 50 trades. And that's only because I've been practicing that I can do that many in an hour. Most people, you're going to get a couple done in an hour because you're just not practiced at it. So I'm nothing special. It's just I've done it so many times.
Depending on the setup, if it's a new setup or what I've been working on, I can get between 10 to 30, I think, in an hour, a couple hours.
Yeah.
But it's not when you're first starting out. When you're first starting out, like a lot of that is just trying to figure out what the trade even is. What's the idea? Yeah.
And, you're not going to have the answer today. You're not going to have the answer tomorrow.
Nope.
And you don't need it yet. Because if you had the answer to everything right now, you don't have enough money for it to be meaningful anyway. So, and I don't care who you are. If you're just starting out in the market, you probably don't have $1 billion. And if you did, you could probably just hire the best people in the world to do it for you and, go do something, take $1 million of your own money and tinker with it or sure, whatever. But for the most part, like no matter who you are, if you're just starting in this game, let's say you're starting with $1 billion. If you do it right, you're going to have all the billions by the end. But yeah, no, we're here to just do that. So, one final thing on that was to the crypto point is, that's where it's an easier game, but it's also the risk is bigger and your returns are bigger. And it's a place where this level of discipline, by the way, this level of discipline doesn't really exist in NASDAQ S&P. So imagine how little this level of discipline is in crypto. So these are edges that you can choose to use or not. I know that the majority of people are not going to do it because it's actually hard to do this stuff. So if you actually do it just once, you're so far ahead of everybody else on the field. So it's an edge.
I think what the takeaway for me then is that it doesn't matter if you're doing it right or wrong. It just matters that you're doing it. And the more you do it, the better you're going to get at it. So it's like anything that you want to like start doing and become good at. You got to just go out there and do it, make the mistakes and learn from them. Totally. If you don't, you got to start somewhere, right?
Yeah, absolutely. It's totally available.
And if you can't start yesterday, then start today.
It's available to everybody. Everybody, if you have the internet, you can make this happen. Even if you don't have the internet, you could figure out how to get data and create your own charts. How we used to do it, or not me. Not that much of a dinosaur, but I mean, there are folks that's their back testing is the manually drawing the charts to just get into the sync of every bar.
That's kind of an interesting experiment. I might give that a try one of these days just to see.
You actually learn quite a bit.
Because something about putting pen to paper. Yeah,
absolutely.
All right, Chris. Where can people go find you if they want to learn more about some of the stuff that you're doing here?
At Christy Macro, CHRISD MACRO on Twitter. I also PollinateTrading.com is my company, and I am working to get back into the YouTube game again.
YouTube's fun, isn't it?
I mean, I've I don't know, 1,000 videos, maybe 300. I don't know how many videos I've got there.
I'll make sure it's in the episode description because I definitely want to go look through some of those because I'm sure you got some real gems in there.
This stuff's in there.
Yeah,
this stuff is definitely in there. It's for free on my YouTube, and I'm going to be a lot more focused on it as we get going into this huge bull market for the next 2 to 3 years.
Right?
Calling it.
Yeah, and you're not the first. I talked to an economist who had the same thing to say. He said, point to one economic indicator that gives you reason to be bearish. I'll wait.
Yeah. It's one everybody wants to happen, but still hasn't.
Why? Yeah, he made the great point too. Like, why does everybody want the markets to go down? It's okay to root for it to go up. It's our team.
That's right.
We want our team to do well.
Excellent point.
All right. Fortunately, though, we have come to the end of our time with Chris today, but the fun does not have to stop for you. You can follow him on Twitter at Chris D. Macro. You can check out PollinateTrading.com, where he writes a newsletter covering everything from systems to tech to health and mindset. You can also check out that YouTube channel. The link will be in the episode description, I promise you. If you enjoyed today's conversation and are looking for more, please check out our guest directory. We can browse all the amazing people I've had the pleasure of speaking with in the past. We'll be back soon with another exciting episode, but until then, tap that 5-star rating and help spread the word. Bye. This podcast is intended for informational and educational purposes only. It does not constitute financial or investment advice and should not be construed as such. The hosts, guests, and contributors of this podcast are not licensed financial advisors, brokers, or professionals. Any trading or investment decisions made based on the content of this podcast are solely at the listener's discretion and risk. Trading and investing in financial markets carry inherent risks, and past performance is not indicative of future results. Listeners should conduct their own research and seek advice from qualified financial professionals before making any financial decisions. The views, opinions, and information shared in this podcast are those of the individual contributors and do not necessarily reflect the views or policies of the podcast creators or associated organizations. Produced by China Shop Productions.